Hello, I'm Simon Edelsten from Goshawk Asset Management, and I thought it was time to do an update on valuation, how we see valuation around global equities. We run funds which select equities from around the world, but we always look for value for money. We have two ways of doing it, both which were outlined in recent vlogs that you'll find on our website. A process that we call our value model. We look at all the investments we make either in terms of their cash flow growth, the ability of the company to generate cash to support the share price over the long run and to justify the price we're paying today. But there are also times when companies are not making very much money, and yet the value of their assets, the value of their market position, the value of their know-how and market position, intellectual property, all those sorts of things can still be worth money even if they're not earning that much money. And so we try to make an assessment of those values, which we call our asset-based valuation approach. We look at this for every stock we buy. We look at both aspects, and it doesn't surprise us that some companies, like technology companies, very seldom have much support for their share prices from their asset value because they tend to have very few tangible assets. But they normally justify their valuation, or can justify their valuation, because of their growth and their cash flow generation. Whereas at the other end of the spectrum, something like a utility or a telephone company or an oil company, you would expect to have plenty of assets. Those assets may also generate lots of cash flow. They may even grow from time to time. But you would expect that asset style of valuation to justify the share price more often. In fact, it's quite often we'll find companies which trade below the sale value of their assets. And so sometimes when we think that the market's a bit overstretched, especially because there's too much enthusiasm about growth stocks out there, we balance our portfolios out by buying a few more of the out-of-fashion asset-backed stocks that we can find. And indeed, it may not surprise you that our view is that those are the conditions we're in at the moment. We think that quite a few technology companies, particularly some very high-profile ones, including ones which have recently come to the market, look extremely stretched on valuation, more stretched on valuation than any large companies, frankly, that I've seen in my career. Perhaps up there with how stretched things were in 2000 in the TMT bubble. But that was a very rare event. But basically, there are some very expensive stocks out there on our way of doing the valuations. On the other side, there are also plenty of opportunities in less fashionable parts of the world, such as asset-backed type companies, some Japanese small companies, even some UK companies these days, which are trading on very, very modest valuations against either the sale value of their assets or their cash flow. And so, as you would expect, we're rebalancing the portfolio, and it looks less and less like the index, which is very dominated by those technology stocks. Now, some people wonder, and they say, well, if you think that there's a technology bubble or an AI bubble, doesn't that mean to say that you should sell everything and run away? Even in 2000, funnily enough, that wasn't the case. The out-of-fashion stocks from 2000 even through to 2003, when the stock market as a whole was falling like a stone, these out-of-fashion stocks actually carried on generating perfectly good nominal returns. Things like the mining shares at that point, which fortunately in the firm I was working for at the time, we did sell we sold most of our technology shares in 2000, and we did buy some mining shares which were trading below asset value. And funnily enough, over the next 10 years, those went up nominally in value. So you don't have to sell everything. The stock market is lots of different clusters of stocks, but they're not all tied to each other as if they all have to go up and down at the same time. Obviously, in a falling market, you've got to be much more careful about what you buy. You've got to be much more cautious about it. But if you can find that asset backing, then we think it's not necessary to leave all your money in the bank. You can still find good investments out there. In fact, I would say that the concentration of overvaluation in technology around the world, not just the US, but also in the emerging market indices, is quite localized. It's a small number of very, very large stocks, so it makes up a very large amount of the index, but it is a small number of stocks. So there are lots and lots of other stocks out there which we still think offer good valuation potential and fit in our portfolio style. So just to give a couple of examples, which I have mentioned before in articles in the FT over the last few months, even in the growth part of the market, companies which have had very good long-term growth potential in sectors which have pretty reliable long-term growth potential, some of them have been completely ignored because all the attention's been on technology and are now actually trading on slightly lower multiples than is usual for them. We would actually say a lower multiple is required because interest rates are higher than they were 5 years ago. As we all know, we're back to fairly normal interest rate conditions, whereas in the 2010s right through to after the pandemic, interest rates were basically zero. So that tended to puff up the price earnings ratios or the cash flow multiples that people would pay for growth stocks in those conditions. So you'd expect them to be a bit lower, but all the same, this does bring some of these stocks down to what we regard as reasonable valuations. We wouldn't say that they're dirt cheap, but reasonable valuations. And amongst our large holdings, I'd include their Netflix, I'd include their Thermo Fisher Scientific, which is in the academic and material science, bioscience supply. It's the world leader in making scientific equipment. About half of its revenues are just the consumables that equipment need when they're used. They've had a slowdown from their normal growth rates, partly because of a slowdown in China demand. But we don't see any reason to think that the long-term, the 5 to 10 year growth story of that sort of stock is in any way diminished. On the other side of the equation, we also think that there are an interesting increase in the number of asset-backed stocks out there, which seem to be enormously unfashionable. Now, when you're buying something because it trades at a discount to its assets, almost by definition, you're not buying it because you think it's suddenly going to spring to life and grow very quickly. But you do think that the share price either doesn't reflect the value of the underlying assets or doesn't reflect the cash flows that the company throws off. And I'll give two examples of that, both of which we've added to the portfolio recently, and both of which we think are made much more obviously assets you'd want to own by the international events of the last 3 months, and particularly the war between the US and Iran. We would say that it clearly increases the value of wind farms in the UK, Europe and America, because they can generate electricity without having anything to do with the oil price, obviously. And then secondly, gas reserves, particularly in Europe. So the two companies which dominate those areas are Edelsten, Danish company, actually built rather too many wind farms, got themselves a bit too much in debt, but they spent the last 2 or 3 years restructuring themselves, changed chief executives, and we now think it trades on about 1.5 times its book asset value. Now, if you try to build those wind farms today, which is what book asset value is based on, it's based on the historic cost of building these things, almost certainly the replacement cost of those wind farms would be above the current enterprise value of the company, we think. And in any case, even if it isn't, the company generates plentiful cash, particularly at current electricity prices, out of those wind farms from the electricity it produces. And then secondly, Equinor, a company that used to be called Statoil, which is Norway's national oil company, which basically owns most of the gas in the North Sea that, frankly, Britain, the Nordic regions and Germany rely on, and will carry on relying on for years, particularly if we don't go back to importing Russian gas. So those reserves, to our mind, are massively enhanced in value by what's going on. And we don't think that people are just going to go back and say, oh, the Middle East, it will quieten down again. I mean, I think it's fairly obvious that to me anyway, that you have outbursts of violence, but the peace is always quite fragile. And therefore oil supply is quite fragile. And gas supply is absolutely necessary as part of any energy mix, including for net zero type plans, because you always need power source that you can turn on and off quite quickly when electricity demand peaks. So even if it's not used for bulk electricity production in the very long run, it'll carry on being used for spiking electricity production, because you can turn it on and off in a way in which you can't turn on and off a wind farm or even a nuclear power plant for that matter. They're either on or off. And Statoil, again, seems to be trading on only 5 times its cash flows. So offering a much more solid valuation support than the technology stocks that dominate the index. And we think that by having a balance, it's not to say that we're selling out of the technology stocks. In fact, IBM is one of our biggest holdings, could be a great beneficiary of AI, but it's on a much more modest rating than most of the headline grabbing stocks out there. So we haven't given up on the AI story. We still find ways to invest in it, but we're balancing the portfolio out and looking to have a higher balance, because we're towards the more asset-backed parts of the market, because we are slightly concerned. We are concerned about the excess valuation of some very high-profile recent technology launches in the market. And I hope that you found that interesting, useful. You know where to find us if you have any questions. Our website is www.goshawkam.com. Thank you very much for listening to the vlog. Goodbye.
The content of this video is provided for information purposes only and is not intended to be an offer or solicitation, nor is it intended to be investment advice. The funds run by Goshawk Asset Management may have positions in any of the stocks discussed, but their inclusion in this video should not be taken as a recommendation. Historical performance information is presented by way of example only, and this video may contain forward-looking information that is not purely historical in nature, with no representation made that the performance presented will be achieved and no guarantee that any forecast will come to pass. Reliance upon information in this video is at the sole discretion of the viewer. It is not intended to be relied on in making or refraining from making any specific investments or other decisions. Opinions expressed, whether specifically, in general, or both, on the performance of individual securities and in a wider economic context, represent our view at the time of preparation and are subject to change. We hope that's helpful.